Hey everybody, Mike DeSepoli, Heritage Financial Advisor Group. Welcome to the Heritage Market Update for Tuesday, April 19th, 2022. Hope your week is off to a great start. A lot we want to cover with you today. I want to spend a little bit of time on the markets, then I want to shift and talk about some of the economic cycles and market cycles that we're going through right now, how we think the last 6 months and the next 6 months have contributed to where we're going in this market, how we see it playing out, and how our thesis is going to take shape here. So let's get right to it. Let's start with the market. Looking at the NASDAQ today, all three major market indexes had a great day today. Broad rally across the board, coming off a slight declines yesterday. Investors were in a buying mood today. So just looking at the NASDAQ at our 9-month view here, not much has changed since last week, right? We're still really in no man's land, halfway between the lows and the highs. The overhead resistance, that level that we've spoken about, 14,500 on the NASDAQ. It's taken a couple attempts to get through it. We have been unsuccessful to do it just yet. And previous times, this time holding true, when we're unable to break through resistance, market needs to pull back a little bit. Now, will remain to be seen. Will the market build and break higher off of this level here, or are we going back down to the lower end of the range? But nonetheless, let's acknowledge some of the positives. After a long slide, the market, at least for now, seemingly has stopped going down, right? Which is a good thing, because the first way to end a correction or a crash in the market is we have to stop the bleeding. So we think the market is doing the necessary work right now, but we are basically halfway between the highs and the lows. So the market is in the middle and is going to have to pick a direction soon. As earnings season kicks off, we already had some of the large banks reporting, some bigger tech components later this week. The market is likely to have a lot more information to deal with and make a decision about which way it wants to go. Looking at today's rally, pretty broad-based rally. Most sectors higher. 10 of 11 major market sectors higher today. The one holdout being energy. So at least for one day, the inflation trade unwinds a little bit. And we saw some relief bounces in some other areas of the market. Okay, so enough on the markets. Let's talk about economic cycles, business cycles, market cycles, right? And we put together a little bit of a visual here to try to illustrate this. So let's just back up for a second. Let's go back to 6 months ago and talk about how we got here, right? So 6 months ago, all the talk, really 6, 7, 8 months ago, all the talk was about how strong the U.S. economy was, right? The economy is so strong, the Fed has provided enough support and stimulus. It is time for the Fed to act, to restrict the economy, to kind of rein in some of that economic growth. And how are they going to do it? By raising interest rates, right? So that was the conversation 6 months ago. Now, we've come on the video twice a week for the last 6 months and talked to you about our expectations for this Fed tightening cycle. Is number one, yes, we knew they would raise interest rates somewhat. To this point, we've seen one interest rate increase. We know there's going to be more to come. But remember, right, a lot of the big economists out there are projecting that we're going to get 10 interest rate increases, okay? So our belief case from day one has been the Fed would embark on a tightening cycle, right? They wouldn't even get halfway through it. And by that point, recession bells would be ringing, and it would cause the Fed to have enough concern to back off some of their aggressive monetary and interest rate hiking plans. Now, Mike, how do you know that that's going to happen? Well, folks, we have lived through this before. This is not the first time this has happened. This is not the second time this has happened. But let's just recap what that looks like in the cycles, and then I'll point you to some hard economic data, right? So the cycle begins right up here at the top, right? The economy weakens. Now, fill in the blank for the reason why the economy weakens. Back in '08, it was the great financial crisis. Back in 2015, it was a sovereign debt crisis. Back in 2018, the Fed made a few policy mistakes and weakened the economy. And then fast forward to 2020, it was the pandemic, right? So fill in the blank, economy weakens for a reason, right? Then what comes next? Well, the Fed steps in and provides economic stimulus primarily through lower interest rates, right? Because when we lower interest rates, we facilitate more money moving around the economy. People can borrow for cheaper and more money available to spend. Great. What happens when we stimulate? Guess what? Markets rise, okay? So far, so good. We've seen that happen many times. What comes next is the period we're living through right now. So then the economy gets hot, the markets get high, and the Fed threatens to raise rates and remove stimulus. Now, the first part of this is just verbal, right? They haven't done anything yet. They're just talking about it. That, in turn, causes markets to fall. And what happens when markets fall? When markets fall, other than prices falling, something happens that we call demand destruction, right? Consumer demand in the economy starts to slow down because naturally people have a lot of wealth invested in the stock market, and I'm sure they're all invested responsibly. But anytime we see our asset values decline, what do, right? We tend to hold on to our money a little bit more closely, a little tighter to the vest. We get a little bit concerned, sit up on the edge of our chair, and we want to make sure that the wealth effect is not going to go in reverse on us, right? So, this is the point where we were just at, right? Markets just fell for the last 4, 5, 6 months. Well, what's happening now, right? We're starting to get signs that the economy is weakening. Now, and again, folks, I'm not happy about this. I don't want you to think that we're rooting for a recession. We're not. But all we need is the fear of a recession, not the recession itself, but just the fear of it, for the Fed to start to walk back some of their plans for this extensive interest rate hiking cycle. And again, if it gets really close to recession, like we did in 2018 and 2019, I'm going to bring you some data of that in a second, what happens again? We'll be right back to this point right here where the Fed will fire back up the stimulus, they will lower interest rates, and we will repeat the entire cycle again. So, besides the fact that we've lived through this multiple times, how do we know that this is the narrative that's starting to take shape? Well, you knew 6 months ago that everybody was talking about how strong the economy is. Well, now let's look at what the media is talking about now. Well, here's an article from Wealth Advisor, and these are all from the last couple of days, just so you know. Recession risks, dual resilience, hopes in a global economy outlook, right? CNN, the world may dodge another recession, but the risks are growing. Bloomberg says Goldman Sachs sees a U.S. recession odds of 35% over the next 2 years. I always love when economists project, as an aside, folks, I always love when they predict that we're going to see a recession over the next 2 years. Well, if you could just keep saying the same thing over and over, you'll eventually be right. And we do have a joke in finance that economists have successfully predicted 12 of the last 3 recessions, right? So we do hear a lot of these predictions, but nonetheless, you weren't hearing any of these predictions 6 months ago. Let's keep going, right? On CNBC, Goldman Sachs says recession risks are growing, but it's too early to worry. Here's why. And then today, the International Monetary Fund, IMF, cut their global growth forecast to 3.6%. Now, they're citing the war in Russia and Ukraine as the reason, but we all know economically that is a very small portion of the global economy, and a lot of the risks that are forming for recessions were in place long before the war started, but everybody likes a scapegoat. And let's just take it one step further. When we look at Google Trends, right, we can look at what people are searching on Google. This is the results for the word recession being searched on Google, right? Base case, very baseline, very low for quite some time. All of a sudden, look where we're at. Okay, now again, just because people are searching for it doesn't mean it's going to happen. But when we look for what exactly are people searching, is a recession coming in 2022? Are we in a recession 2022? Will there be a recession 2022? The point is, folks, is that the narrative has dramatically shifted, right? The narrative has dramatically shifted from an economy that is too strong 6 months ago to now the fact that there's concerns about a recession and recession bells are ringing. So let me put a bow on this whole thing for you. This is what we've been telling you for 6 months. And again, to reiterate, we're not rooting for a recession. We never have and we never will. But what we told you back then was that the Fed, with all their bravado and bluster, was going to talk about all the interest rate increases they were going to do, 6, 7, 8, 10 interest rate increases, right? They were going to be real serious about fighting inflation. Well, here we are. The economy is softening, okay? And now what we have is a scenario where the Fed may have a little bit of a wrench thrown into some of their plans. And you know what? I'm going to bring you up one more thing I forgot to load up here. We've all seen this, I'm sure, okay? This is the U.S. debt clock, folks, right? You've probably seen pictures of an image of it online. Now, what I'm going to point your attention to is the top left corner. This is our U.S. national debt. This is reason A1 why the Federal Reserve may raise interest rates, but they're not going to do it much, right? Now, I'm going to ask you for a second to envision yourself being the banker and the mortgagor at once. Let's say, right, a lot of you have mortgages. We all have mortgages. Let's say you have a mortgage like you do, and you also get to play banker, right? And as banker, you get to move interest rates up or down, But if you move rates up, your mortgage becomes more expensive. And if you move rates down, your mortgage becomes cheaper. This is essentially what the Federal Reserve is doing right now with the U.S. national debt and their control of interest rates. So, with the Fed in charge of rates and the U.S. national debt at 30 trillion and climbing, how high do you really think, folks, that the Fed is going to raise interest rates? Do you think they're going to 10%, 12, 15, 18% like the 1980s? I don't think so. And the numbers here would suggest that that is not going to be the case. So, in summary, this is how we have anticipated this playing out for the last 6 months. Yes, the markets have been ugly. Yes, they've been very difficult to navigate. We understand that. But sometimes we need to go through periods of pressure in the market to get to the green pastures that come next, right? We all know diamonds are created under pressure. We think this is no different. So when you line up all the facts, when you line up all the data, we know the Fed is on a path to raising interest rates, but here at Heritage, we don't think it'll be nearly as aggressive as the markets have priced in, right? The markets have priced in 9 interest rate increases. We've had 1. So if the Fed falls short of 9, if they get to 4, if they get to 5, if they get to 6, and they pivot, watch out because this market's going higher and it's going to do so in a hurry. So I hope this is helpful for you folks because I know a lot of people have reached out to me about things they're reading about recessionary concerns and how this could be a big problem for the financial markets. And I understand it sounds contrarian in nature, but again, we don't need a recession. We don't want a recession. All we need is the recession bells to be ringing loud enough that the Fed hears it, and they will hear it. And I'm going to show you one more thing before we go. I know we're getting a little long here, but let's go back a couple short years ago to the last time that the Fed did this, okay? Let me introduce you to the fourth quarter of 2018. A lot of you were with us during this period of time. Economy was hot. Fed said we have to raise interest rates. They started raising rates. They did it a little too quickly and too much too fast. Markets fell from about, let's call it about 8,000 on the NASDAQ to about 6,000. Okay, so 25% decline, more than we've seen the markets drop now. And then the beginning of 2019, right around this point, the Fed realized we've done a little bit too much. It's time to pivot. We don't need to be as hawkish. Rates don't need to go as high. And then we can look at what the market did after that until we ran into the COVID pandemic, right? So, folks, history may not repeat itself, but it tends to rhyme. This is what we're looking for. This is the cues and the clues that we're drawing on. So we wanted to take you along the ride today to explain it to you in more detail so you can see how these talks and thoughts about recessions, as long as a recession doesn't actually happen, which we're not calling for one this year, we think that this will be constructive developments for the market. So if you have any questions, please reach out to us. Always here to talk with you about anything that's on your mind. I hope we didn't go too far into the weeds today, but we really felt this information was important and we wanted to convey it to you, accurately. So if you have any questions, reach out. Otherwise, we'll see you back later this week for the Heritage Market Pulse.